Okay, so we are almost halfway through the year. So what are the top picks for the rest of 2023? As we can see, there's a lot of things happening in this world. So let's get down and let's check out my top 5 picks for the top 5 stocks for the rest of 2023. Let's get down. Let's check this out. Okay, so my first pick is Enbridge. There's actually a really good reason why I am picking Enbridge. Now, Enbridge is obviously a gas/oil transportation company, and they are using, of course, pipelines. Now, when we look at their company write-up, we can see that, of course, yes, they do gas and oil transmissions. And now you may be saying, well, that's terrible for the future because, of course, we're going to be going over to electric cars. And, of course, all of these new environmental laws that are coming in. But I have my reasons. Number one is Enbridge is investing heavily into green energy. They're doing wind farms, solar farms, and of course, we all know that that's probably going to be the future. However, what is currently happening in the world when it comes to oil is the fact that oil prices are probably going to go up substantially because now many countries are no longer trading oil with American dollars, which means that American dollars could potentially be going down and oil could be potentially getting more and more expensive due to currency fluctuations, but also due to, of course, the issue of the wars that are happening and potential wars that could happen in the future. So that's the different reasons why I am picking Enbridge. But there's more reasons than that too. A big reason is, of course, the dividend. The dividend is huge. It's at 6.73%. That is huge. Volume is also very good, into the millions per day. And with heavy volume means that you can buy and sell the stock pretty easily. You can get in and out pretty quick. Now the earnings, we have seen that they have missed 2 quarters and they have also had 1 quarter where they beat estimates. And if we look at their revenue and earnings over the past 4 years, their revenue is up pretty high. Their earnings are a bit lower over the last 4 years. However, whenever you have huge revenue, earnings can be easily followed. If we look at their 6-month chart, we can see that they hit a double top, which is why they went down. However, they just recently broke through that level of resistance, so they could have a little bit more room to go up. But if we look over the last 2 years, they're trading pretty much in a range in a way where they're bouncing off this level of resistance multiple times, which means that this could be a good buying opportunity at this point in time. Keep in mind, I personally do not own Enbridge stock, but I do have family members who do, so that's just for full disclosure. If we look at their dividends over the last little while, they have been easily increasing their dividends over year, which is fantastic to see. The next stock is Fortis. Fortis is actually a very interesting stock and does pay a 3.8% dividend at this point in time. Their volume is up into the millions too, so again, very easily tradable. Now, what does Fortis do? It is an electric and gas utilities company that operates in Canada, the United States, and Caribbean countries. They operate different wind farms as well as many different other options like hydroelectric generating facilities. Now, I am actually massively really interested in the whole electric company idea where you can buy into electric providers, because as we know, every single year there's more and more electricity being used, and that's not just from different devices like my computer, my iPad, my microphone, my camera, my lights. Not just that, but the fact that now these governments around the world, especially Canada and the United States, are really trying to push for electric cars. There needs to be infrastructure for that, which means that the governments are going to be paying companies like Fortis and Enbridge to be able to, of course, expand green electricity because that's just what these governments are wanting to do. So you might as well just jump on board and ride the bandwagon up while these governments are trying to push money into these types of companies. If we look at their financials year over year, they increase. However, for Fortis, their earnings have been decreasing, but their revenue is going higher. To me, as long as revenue is going higher, it's good. Revenue is king. And they've had 2 quarters in a row of beats and 1 miss. Their 2-year stock price was doing extremely well. However, recently, just like pretty much almost every stock, it has declined, but it's going back up, and it's just recently had a massive jump. Over the past 6 months, we can see that there was an increase, then it stagnated, and now it's starting to increase once again. I really wouldn't be surprised if it came back down a little bit from this point, but this does look pretty promising. If we look at their dividend, once again, it does increase almost pretty much every year, which is exactly what you're looking for. Next is CNQ. Yes, of course, more oil stocks. This is the whole theme right now because I think that oil prices are going to go through the roof. People with cars are going to be buying gas anyways. It's the summer, it's the travel season. That's number 1. Number 2 is the fact that with all of these different wars that are going on, there's going to be probably some kind of retaliation when it comes to oil. We are already seeing that when it comes to, like I was mentioning, the different countries no longer using American currency to purchase oil. That doesn't do much, but it does or can deflate the American currency, in which case that American currency buys less oil, in which case, of course, you now have to pay more money for oil. We're Canadian. We have to buy oil through the States. We buy it through the American dollar. And, of course, that screws us when, of course, currency fluctuates. Now, this does have a 4.5% dividend and millions of volume, again, easily tradable. I personally love stocks that are over 4% dividends. That's just myself personally. As we can see here, CNQ acquires explorers for develop, produces, markets, and sells crude oil, natural gas, and all of the, Anyways, that's basically what I've already said. Revenue has been higher recently as well as earnings. Of course, oil prices are up, and they've had 2 beaten quarters and 1 missed. If we look at their 6-month chart, they are pretty much trading within a range, and it's near the higher point of that range. If we look at the 2-year chart, we can actually see some interesting features like this one, where, of course, now it's trading in this range where now, in my opinion, if it breaks above this point, it could actually accelerate quite higher. Full disclosure as well, all the companies so far that I've spoke about in today's video, I do not own myself at this point. I have, however, owned them all at some point in my life, and they're all owned by family members of myself at this point, and I may have a couple here or there inside of ETFs. They do increase the dividend. This must have been like a nice one-time dividend. I haven't followed this stock since I last sold it around 2020. However, they do continuously increase the dividend year over year, which is exactly what you want to see. You never want to buy a stock that's been decreasing dividends. That's just my own personal opinion. There's reasons why companies may decrease a dividend. Of course, if they want to do more search or more exploration in their own individual fields of whatever company they are trying to be. But usually it's a bad thing. Next is Loblaws. Loblaws, of course, is one of the lower dividends in this video, but high volume still in the hundreds of thousands, 1.2%, 1.3% dividend. But Loblaws has had some bad coverage. Metro is another one where they've had some bad coverage in news media because news media just doesn't understand how business works. They're reporters. They know their own beliefs or whatever they want to believe in, but in reality, they do not know business. Why has Loblaws and Metro had such bad press? It's because they're raising prices. I just recently went into Metro today and looked at the frozen pizzas and said, oh my God, they're $10. Are you joking me? I could go out to Domino's and get a pizza for like $8 and it's already cooked. So why are they going up such a huge price when it comes to the stuff that's inside the stores? Well, every company works on a profit margin. So, for example, if a pizza was worth $1, let's say, and they wanted to have 100% profit, for example, let's say they want to have, if they buy it for $1, they want to sell it for $2. Let's just say that's their margins that they're going by. I don't know how their margins work, but if their margins are $1 and they have to make $2 on that pizza to, of course, pay for electricity, pay for their employees, all that stuff, right? So if they're paying $1 for the pizza, they want to sell it for $2. Well, what happens if tomorrow they buy that pizza for $3? Well, now if they want to have that same profit margin, they can't sell it for $2. They have to sell it for $6 because now they still want to make that $3 back and then make $3 on top of it. That's just how their profit margins work. That's the same with every company. They want to keep it around the same. I remember at one point Apple wanted to be around 50%. So if Apple bought a pizza for $1, they would be selling it for $1.50. That's just how it goes. So that's why these companies are raising their prices, because stuff is costing more money for them. So they want to make the same profit margin as before. As it says, they're a grocery company. Their revenue is going up every year, same as their earnings, of course, because, of course, things are just costing more money. They've had 3 quarters in a row where they've beaten, and they're consistently going up over the past 2 years as well. Over the past 6 months, they've broken past the level of resistance that was here, so this could have some more room to run, potentially. And they increase their dividend every year as well. Last but not least, Royal Bank of Canada. Now, I'm a big fan of banks in general, but Royal Bank of Canada is, in my opinion, more associated with Canadians than banks like TD, where they've got a massive operation in the United States, or Scotiabank that has a massive operation in the Caribbean and Europe. So from here, this is why I like Royal Bank of Canada. I think that Canada is going to go through a recession just like the United States over the next few months. We've been in a recession, in my opinion, for well over a year, but there's of course stock reasons behind this. It's got a 4% dividend. Volume is quite large. They've had 2 beaten quarters, 1 miss, and of course their revenue is high, but it has fallen a bit this past year. Yes, they're a Canadian bank. They make money like crazy. Their 2-year stock price, yes, it ballooned and then it's gone down. Now it's pretty much trading within a range, and it's actually quite a long-term range as well. So from there, I think that I wouldn't put all my money into this. I would put, if you were looking to invest in a Canadian bank, just a little bit. They increase their dividends every year. But also when it comes to dividends in Canadian banks, the big 6 banks have never actually lowered their dividend for well over 100 years. So again, been through multiple big recessions and never lowered their dividend. I hope that you've enjoyed it. Yes, I've lost my voice pretty well. I got to yell in a basketball game that I coach. Had some issues with another coach. Anyways, I lost my voice from that. I hope that this video has helped you. If it has, hit that like button, subscribe. Of course, do your own due diligence, research the companies yourself, and I'll see you guys again next time.